What is a debt to income ratio? Well, it's one of the main pillars of the loan approval that is kind of considered by an investor. And in layman's terms, what it is it's really your total monthly debts plus a new proposed house payment divided by your gross monthly income. Now, calculating monthly income is something we'll talk about in a different video, but it's what we are going to use for the qualifying income from an investor's point of view. So what debts are considered? Well, they're really going to look at things that are just basically going to be on your credit report. It could be credit cards, student loans, car payments, other installment debts that you may have. If you did debt consolidation or you borrowed something on a personal line, or other mortgages that you may have. Now, we're only going to look at the minimum payments on those debts. So, for example, if you had a $5,000 balance on your credit card and you're paying $500 a month to kind of work on that balance, we're only going to, but your minimum payment is only $50, we're only going to qualify the debt to income ratios with what the minimum payment is going to be, not what you may be actually paying. Debts that are not considered, utility bills, your cell phone, if you borrowed against a 401k, if you have car insurance or health insurance or life insurance, those are really not considered in a loan approval stance as a debt against you. So when we look at debt to income ratios from a lender's perspective, we're going to look at two ratios. We're going to look at a front ratio and a back ratio. So a front ratio is really your proposed monthly house payment. What's going to be there for the total payment, the principal and interest, if there's taxes, taxes and insurance, if there's mortgage insurance, if there's a homeowners association. We're going to kind of take that monthly payment and divide it by your gross monthly income to come up with a front ratio. A back ratio is going to be that same monthly payment plus your minimum monthly debts, then divided by that same gross monthly income. So traditionally, on a front ratio, we try to, it stays around 28 to 32%. And on a back ratio, it could go from about 38 to 44%. Now, these are just kind of general kind of boundaries that they see. These both can go higher, and it's going to really depend on maybe some other offsetting factors. They don't just have a set number that the debt to income ratio has to be in. So things that could offset that would be, if you have, you're a stronger credit profile, if you're putting more than the minimum down payment down, or if you have reserves. Now, reserves are a really good compensating factor. Your retirement accounts like your 401ks or IRAs can be considered as reserves. And it just, from an underwriter's perspective, it's just money that you have left after closing in an account that you could use if you needed to. So that's a good offset to maybe push a higher debt to income ratio. Now, typically the maximum is about 50%. And once with some good compensating factors, we can push that debt to income ratio to around that 50% number. FHA and VA actually will go a little bit higher, and that's really going to come down as a case-by-case basis. Now, you can always try to calculate your own debt to income ratio. My advice is that you really try to work on working with a mortgage professional to make sure you're having all the variables kind of viewed in consideration of what your total gross monthly income is and what your minimum monthly debts are. There may be debts that may not have to be considered because someone else is paying them, or they're going to disappear in some time frames. So it's always good to make sure you have a good view of what a lender is going to see.